Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. Yields, the 10-year yield hit the highest level since 2007 today.
And did you take a look at real yields?
Are they up above 2?
They're super high.
They're getting there. All right, let's get to the biggest stories right now in the more than $10 trillion global ETF industry. It's huge, but ETF launches are dropping almost 30% this year. Does that mean the industry is diminishing?
We're going to find out. We're also going to talk about TCW. It agreed to buy the ETF business of Engine No. We're going to speak to CEO Jennifer Grancio about that new partnership.
And as I said, 10-year yields at a 15-year high as the persistently resilient economy has investors positioning for interest rates to remain elevated.
Well, on that note, Eric Balchunas, he's off today. So let's take a look at where the flows are actually going. Of course, we know that last week the S&P 500 finished down for a third straight week. You can see that we still saw some love for S&P 500 tracking funds. IVV took in about $1 billion, but there it got kind of risk off. I want to highlight SGov and BIL, number 2 and number 4, both taking in about $700 million. Of course, those are short-term treasury funds, cash-like, if you will. Again, typically seen as a place to hide out. Let's look at where money was leaving because, again, fairly risk-off. You've SPY up at the top, losing $7 billion. You go down the list, and corporate credit also seeing a bit of a whiff there. LQD, a lot of letters, that is investment grade, taking out $1.8 billion. Investors also leaving JNK, that is high yield debt, also losing close to $1 billion. But given that it's August, given that it's almost September, I want to take a look at the state of the industry. We know that launches in blue have really been on fire. We saw quite an uptick heading into the end of 2021. That's really flatlined. You can see we've gone to the right here, sideways. Meanwhile, closures in yellow, I wanted to point this out, Matt, you've really seen them tick up. And so far this year, actually, we've seen 156 ETFs launch in 2023. I just ran those numbers. That's the highest since 2020. So you've really seen that gap start to shrink.
All right. Katie, with a look there at the broader industry, let's talk about this right now with Matt Bartolini. He's head of SPDR Americas research of State Street Global Advisors. Matt, great to have you here today. What do you think about the slowdown that we've seen in launches? You've seen closures tick up here. How do you gauge the global ETF industry?
Yeah, I mean, I think some of it has to do with the negative returns we saw last year in both stocks and bonds. It was a pretty risk-off environment for global capital markets. And from a product perspective, when you're trying to launch a product, it takes a little bit of a while. And you probably start that in and around last year. Now you're starting to launch it in this year because you do have that 90-day window between your first filing and when you can actually go effective. So I think some of it reflects really not so much what happened this year, but the weak markets from 2022. Because last year, in 2022, was significant launches because the market returns in 2021 were so superior to a lot of other specific years. So I think a lot of it has to do with just the market environment coming into this year in terms of what we're going to see for launches.
Well, and now, I mean, I pull up the SEAG function on the Bloomberg terminal and look at, for example, the S&P 500. I see that over the last 29 years, which is as far out as I can bring it, August and September are seasonally bad months for equities. What about for ETFs? The kind of flows that we're seeing right now, are those normal for kind of the doldrums of August?
Sort of. I mean, if the month ended today, ETFs would be in net outflows for the month of August. And it'll be the first time ETFs have had outflows in a month of August since August 2013 when we were dealing with the taper tantrum. But August typically does tend to be weak in terms of flows, roughly about $16 billion a month on average in a month of August. That's the lowest out of any other calendar month. And I think a lot of it just has to do with, it is the doldrums of summer. Perhaps just a lot of people are at the beach and not willing to invest.
And I love that for them. It's very much a summer month, it feels like, over the past couple of weeks. But when we think about State Street's lineup, of course, you have SPY, and then you have a whole stable of sector ETFs. And even though August, it tends to be kind of a quiet month, both in terms of performance and flows, are you seeing any rotations among the sectors?
So yeah, I mean, sectors are in net outflows in the aggregate, but there are some green shoots of positivity, particularly within technology, communication services, and consumer discretionary. those three sectors overall are in net inflows. And those sectors do score highly in terms of price momentum. They're they're the three sectors that are actually outperforming the S&P 500 by significant margins this year. But also, just coming off of the Q2 earnings season, those sectors have had some of the strongest earnings results and upward earnings revisions. So we are seeing a rotation towards where, these sectors that can provide growth in an environment where earnings growth is somewhat scarce.
And it's given that it is August, it's nice to reflect on some of the trends because we have seen flows come down quite a bit, even though you are starting to see some interesting things in the sector level. We think about one of the big trends of this year, it's been active ETFs. And to bring this to State Street's own stable of funds, I was just looking at, you have 137 ETFs, only 14 are active. Have you been watching the money go into active products and thinking, maybe I want to get in on that?
I mean, yeah, we keep an eye on all different types of flow types and strategies, active obviously being one of them. And one of our funds, TOTL, has taken in over $800 million this year and $1 billion in the past year. So we've been able to partake in some of the growth of active ETF flows. But a lot of that's been in the equity space. And some of the respects are not so far active in terms of alpha generation, but are trying to deliver some form of outcome like derivative income or defined outcome funds. And that's where a lot of the active flows are going. And from a product perspective, we always keep an eye on those trends. And active ETFs are one of those areas that we continue to look at, both in forms of alpha generation, but also for delivering specific outcomes.
And to bring this back to the launches conversation we were having, Matt, I think it's interesting. You said recently that we may not have hit peak ETF, but we may have reached peak ETF launches. Again, when you're evaluating your own lineup, should I read that as you saying we might not see a State Street launch for a little bit here?
Well, we actually haven't really had that many launches this year overall. I think we're being more judicious in some of the products that we're bringing to the marketplace to ensure that they can deliver on specific outcomes or meet investor goals. Because within our lineup, like I said, we have a pretty strong stable of asset allocation tools, some really sophisticated active strategies, particularly on the fixed income side. On the equity side, there is some room for innovation there from our perspective, and I think that's something that we're going to continue to look at. But in terms of what we saw in the early 2000s and late 2010s, where there were so many launches because the ETF marketplace was still not so mature as it is now, where there's a significant number of strategies. But yeah, I mean, we're not at peak ETF in terms of assets because I think those are only going to go higher. But the record amount of launches that we saw in 2019, 2020, and 2022, I think that is likely going to slow because there's only so many type of strategies they can have out in the marketplace. We've been a big fan of doing more range management recently and really sort of making sure our products are fit for purpose. And that's something we've done more so this year and less so in the launches as we really start kind of plan out that product calendar a little bit more, again, judiciously.
What are the strategies investors are turning to the most right now when we look at, Katie and I were talking about the 10-year yield now at the highest level since 2007, and across the curve, obviously, we've seen a lot more returns. At the same time, the dollar continues to gain strength. What does that mean for your ETFs?
Well, I think you guys pointed out right at the top, one of the big fund flow gatherers in the past week has been BIL. And because of the return environment where you get over a 5% yield and the duration is only basically 0.1 years, and you have the Fed meeting in September, likely to raise rates again, that's going to only push up that yield higher, which obviously that's where your return comes from. So from a ultra short duration or even short duration perspective, that is an area where our funds have done quite well in terms of fund flow gathering, but also performance and bringing it all the way back to active. STOT, our other fund from Double Line, they've had significant outperformance because of the amount of opportunities that you have at the short end of the curve, being able to structure a balanced portfolio, both income and duration. And that's something that really, the rate environment is creating a significant amount of opportunities on that short end to generate alpha.
All right, Matt, great having you with us. Thanks so much for joining ETF IQ. Matt Bartolini there of State Street Global Advisors. Now, coming up, TCW agreed to buy Engine No. 1's ETF business. And now we'll drill down into those ETFs with Engine No. 1 CEO Jennifer Grancio next. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. And remember, last month, TCW, this was big news. It announced that it's buying Engine No.'s ETF business. That's a deal we expect to be completed in the third quarter. And it was interesting for a lot of reasons, Matt. Number one, this is how TCW is going to enter the ETF industry versus through launching its own ETFs, if you will. And it was also interesting because if you think about Engine No., you probably know them as an activist investor, probably for supply chain onshoring. They have 3 U.S. equity ETFs with about $600 million in assets. And I'm really excited to talk to our next guest about how this is going to go, whether we're going to see Engine No. continue down this path of activist investing, if you will, or whether they plan to launch maybe some of those core portfolio products.
I am interested in that as well. Unfortunately, Jennifer Grancio is here, the CEO of Engine No. Jennifer, thanks so much for coming into the studio. Really appreciate you joining us. What does this deal mean for your activism? To me, I think of the board seats that you got on ExxonMobil and that battle. How does that translate now that TCW is buying the ETF business?
Yeah, so we built Engine No. to help investors take advantage of these mega themes and transformations. And so we think you're missing something if you're only index or you're only growth. We had an opportunity with Exxon to use the tool of activism, if you will. But everything we do is about active investing and delivering alpha for people. And so we haven't, done an activist campaign since Exxon, but we work very closely with a lot of the companies in the portfolios. We're a concentrated active investor, and TCW is as well. So TCW is a terrific platform, and they manage assets in an active and also a concentrated active way. And so we actually think this is really exciting and a great fit for the current shareholders and a great way to grow within TCW.
What about the onshoring trend that we've seen, especially since the supply chain disruptions of the pandemic? Do you continue to play that? Is it a mega theme that's going to keep happening, or do we revert back to the mean at some point?
Yeah, I mean, we think these trends have a long way to go. And so mega theme is exactly how we think about it. They're complicated systems. And if you look at reshoring of supply chains back to the U.S., we're just at the beginning of that. And if you look at, I think last year we saw almost 400,000 jobs come back as part of this reshoring of supply chains, huge mega projects. And so if you think about that, these mega projects across the different industries or sectors in the U.S. We're building factories. The factories need to be smarter. They need factory automation. And then from a transportation perspective, we're seeing railways, for example, are going to have a huge opportunity to create value because we're now working within one geographical area. So it's a time to get into supply chain, in our opinion, but we think it's a theme that continues and persists for many years.
And in addition to that theme, let's also talk about Engine No. under TCW, because as you mentioned, of course, TCW, known as an active investor. I think of them, of course, as a bond shop. Putting that together, is it in the future that you're going to be looking to launch active products in more traditional bond spaces?
Well, if you think about what Engine No. does today, we're in the active equity space. And so from a TCW perspective, TCW isn't just a bond and fixed income shop, although they're excellent and they're well known for it.
Showing my bias.
And so I think you'll continue to see more active equity products. And there's also an opportunity for sure to look at the income side.
So it sounds like we should be on the lookout for some filings.
I would say definitely watch the space. We'll continue when the deal closes at TCW on the energy transition. Net Z is the ticker there, and supply chain SUP is the ticker there. But definitely watch the space. More to come. ETFs are a great wrapper, as you well know. And so I think there are a lot of great strategies that either exist at TCW now or could in the future that can take advantage of the tax and transparency benefits of the wrapper.
What are the other mega themes that you're focused on? I mean, you mentioned the energy transition, and I was talking with Claudia Sam earlier about the fact that the incredible heat we've been experiencing is actually reducing the productivity in this country and globally. What else are you watching?
Yeah, so energy transition is definitely one. It's huge, and the part of the energy transformation that happens at scale affects all kinds of transportation, energy, and all the materials and technologies that go into it. And that's why we manage it as an active fund, because it is a big, broad change. We don't think picking by yourself micro themes is the best way to do it. So energy transformation is big. We've talked about reshoring of supply chain. Another one that's filed with the SEC and we haven't launched yet is around scarcity. So from a resource perspective, we're both short some of the minerals and materials we need for reshoring and for the sort of electrification of everything. And then there also will be companies that win, companies that cool data centers, because AI is great, but AI is a huge drain on electricity. And so scarcity is another theme that we'll be launching.
And when you talk about scarcity, again, I'm thinking to your lineup right now, your equity ETF. So is the MO there really to invest in the companies that are sort of taking advantage of that scarcity versus the actual materials?
So we haven't launched that product yet, but when we do, and what's in the prospectus is that we'll take advantage both of places where we're short a material, and maybe we need to mine more copper or lithium because we're short a natural resource, as well as technologies that are more efficient. So because we're in a scarcity environment, the companies that figure out how to maximize efficiency of water use, for example, are also going to be winners. And these products are meant to be ways to add alpha to the portfolio. And so your core, your growth, your large cap index, great, but don't miss this opportunity in these huge transformation areas.
How about the shift in yields? We've been talking about 434 on the 10-year, the highest level today since 2007. And that's kind of a mega theme as well. I guess you could see it as that if you don't think they'll revert to the mean. We're in a new era.
We're in a new era, and kind of no comment on fixed income ETFs at this point in time. But from a portfolio construction perspective, I do think active has a big role to play in the next couple of years because the cost of capital is higher. There will be more stock dispersion, and there is an opportunity to pick winners.
And Jennifer, we're up against the clock here, but I am really curious to get your thoughts on something we were talking about at the intro, the fact that this is a really tough market environment. This is a very saturated market. If you're trying to break ground in the ETF industry, it's really difficult right now. TCW obviously going the acquisition route, but you just lived that life at Engine No. How difficult is it to be a first-time issuer in this market?
Yeah, I think it's difficult, but I also think there's an opportunity to combine like terrific active investors and active track record, this environment where we think just stock dispersion is rewarded. So if you've got great active managers and you've got real know-how on the ETF side, I think you have a better chance than most at building. But it certainly takes some work to build new ETFs and to build them to success.
All right, Jennifer, this was great. Great to have some time with you. That is Jennifer Grancio. She is CEO of Engine No. Still ahead, QQQ. It's one of the most famous funds in the investing universe. It's also wildly profitable, just not for its owner. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with a triple leveraged bond fund. I love this one. It's TMF. It's a fund from Direction, offers 3 times the performance of long-dated treasuries. And as you would imagine, it's getting absolutely brutalized this year. It's down over 22% in 2023. But what's fascinating is that money just continues to pour into it. It's taken in more than $2.3 billion so far this year, even with that performance. It's going to be really interesting to see how it finishes 2023. Let's also talk about momentum, though. We have an iShares ETF here. This is MTUM. It tracks the momentum factor, as you would imagine. It's actually underperforming the S&P 500 by the most ever. It didn't add NVIDIA until May, so that explains why. You can see that its assets really have deflated here, if you will, under $9 billion. You can see that was above $18 billion at one point. But let's also talk about the Qs. This is a fascinating one. We know that the Qs, it's one of the oldest and biggest ETFs out there. It charges a relatively hefty expense ratio for a passive product, about 20 basis points. You're looking at the breakdown here. Invesco makes no money from that. Because it's a unit investment trust, Matt, those fees go to the trustee, goes to NASDAQ, and it goes to marketing, and virtually zero goes to Invesco itself.
Which is nuts because this has performed better than any tech fund, right? I think Eric Balchunas, when he was here, did the math and said over 5 years, 10 years, 15 years, it's been the best performer. And it doesn't matter really what period you pick. Let's talk a little bit more about this issue with Athanasios Sarafagis of Bloomberg Intelligence. Why don't they cash in on such a successful fund?
Yeah, well, they're trying to. So they launched some versions of this. QQQM is another one. But when this first launched, it was just easier to launch it as a UIT. This is what it's set up as. SPY is also UIT. I don't think anyone thought this would be as big as it was, right, when these first came out. But to your point, like, this is such a great act of charity because not only as a performance as a tech fund of any ETF, it's like in the top 10 all time. So it's, you know, it must be also kind of hard for them to watch this product take in money, perform the way it's doing, and know they can't make all that much money off of it.
Well, tell us about what they're doing to try to capture some of the magic. You mentioned QQQM, and I remember when this launched, I was a little bit confused because it's the Qs but cheaper. But when you think about their problem, or if you want to call it a problem with the Qs, it makes a lot more sense.
Yeah, and so the other thing with this is when Invesco or PowerShares bought this, they had an exclusive on it, so no one else could do this. So it seems like there was some agreement over the last couple of years. Now they started launching all these products off of that, QQQJ, QQQM. So anything sort of tied to the Qs, you know, and it's fine. It ends up benefiting everybody. More money goes to Invesco, but also they lowered the expense ratio, so you could actually own QQQM at a lower fee than the regular Qs.
Yeah, I was going to say, it's kind of like a Halo car in that not everyone buys the Halo car, but it gets them in the dealership. In the case of the Qs, everyone buys it, but do they then also buy more from the family of Invesco?
Yeah, I think, you know, we see it with other, you know, products too, with other issuers. You know, they get them in the door, then they're like, hey, we have this like version of this ETF, you know, whether it's sector-based or thematic. So I think it's just a way for to get people in. But also the Qs, the performance has been so strong, so I think that always is going to have people's attention.
All right, Athanasios, thanks so much for joining us. Athanasios Sarafagis there at Bloomberg Intelligence. He covers the ETFs for us there. And if you just can't get enough of ETFs, a reminder that you can listen to Eric and Joel Weber on Trillions. That's their bi-weekly podcast that covers the industry. That does it for this episode of Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld. This is Bloomberg.